Everybody. All right. Let's go ahead and bring in the Zoom, I guess. We're a few minutes early, but I think everybody by now has kind of gotten the hint that I generally start early. There's this old saying, if you're 5 minutes early, then minutes late. I guess I kind of really stick with that. All right. So I was looking around this morning trying to find a name for the morning briefing of something I've been doing lately. Trying to basically sum up everything that we're about to talk about in a little bit of a headline. And I've noticed a lot of the headlines seem to just be the same old headline, right? Because we've been in that kind of market where it's the same thing as yesterday, a little bit of Groundhog Day. If you've never seen that movie, you're really missing out. Groundhog Day, Bill Murray, what a nut. But it's not Groundhog Day. We finally got out of that range that we've been in. So let's just start out like we always do. We want to take a look at the economic calendar first. We've been using FX Street for one of the three calendars that we would want to check every day. Don't sign in. You don't need an account. You just come over and look at FX Street. They usually give you a little bit of a rundown on the dollar and then a list of anticipated impact for the economic events on the agenda today. It's the ISM manufacturing that's really standing out. Everything is about supply chain issues, the lack of staff at work, and then, of course, precious metals, the mining. So, manufacturing, these are going to be important numbers today. They're also a part of the data package that the Fed uses, right? And a lot of the reaction we've seen in the market in the last few weeks is because they really think there's going to be an aggressive uh, push by the Fed in March. Well, what the Fed will do in March is going to be dependent on data like this. Of course, they did a really good job yesterday. There was a lot of Fed speakers out hitting the circuit, the media circuit, kind of going around and trying to undo that Bosick comment over the weekend about the very aggressive 50-point rate hike. And they seem to have done a pretty good job. The market kind of calmed down. We had a little bit of a rally, but I'm going to show you not to trust that rally. Doesn't mean we don't want to trade it. I'm just going to point out some things that make me concerned that perhaps it isn't the rally you're looking for. Right? What's that old Star Wars? These aren't the drones you're looking for. I think we might still be in the sell the rip mode. So ISM manufacturing is the big one. There are a couple others. If we jump over to 5 things we need to know, we can take a look at one key piece of calling a rally, right? Calling a bottom and spotting a rally would be that we see that 10-year fade off. Well, the dollar weakened and the yields dropped yesterday. And it unfolded yesterday because there was a reduced chance of a shock and awe next month, meaning they were out there chipping their teeth trying to undo what Bosick did over the weekend. So they kind of cooled the markets off, especially go Kansas City. Esther George out there really trying to calm down this idea that we're going to just get a really aggressive Fed. Keep your eye on crude. There's been a lot of discussion in the last 10 years that energy doesn't matter. And I've always argued against that. Energy matters. It may not be as weighted now in the S&P as it used to be, obviously. But when energy moves, so does the market. We do have a mixed market, and there are still a lot of Asian nations that are not open. I don't know when their New Year celebration is done, but I think pretty much the whole week it's going to be kind of hit and miss. And you can check every day. You don't have to assume that you know. You can go over to tradinghours.com. It's a free website. Don't sign up or buy anything. Just go over there and you can check the Asian markets, see which ones are open, which ones they're closed, when their holiday is. It's really great information, and it's free. If you noticed last night, the markets were sideways for a long time before they finally started to move. And that was because at 7, when we'd normally start to see that pre-market activity from Asia, just wasn't there. All right, so we jump over to Thinkorswim. We look at the calendar in Market Watch. Monthly GDP, Red Book, PMI manufacturing, construction spending, ISM manufacturing again. JOLTS, which is take this job and shove it numbers. And then the 4-week auction. So when there are additional auctions during the lunch hour, pay particular attention to those. Can't tell you how many times we've gone from a range bound market to a market on the run right at 11 o'clock or right at 11:30 when one of these auctions are announced. I've also seen trends die dead in their tracks, just stop and roll over, do nothing right when these auctions come out. So it can kill a trend or start one. We're good to go after that. So after 11 o'clock, the afternoon is going to be wide open for opportunities to trade. And there's absolutely nothing wrong with maybe sitting back through the morning looking for your opportunity and then trading that afternoon run. I continue to hear from a lot of people who say, man, I got chewed up all morning long. And then when I finally just get sick of it all and I quit, that's when the market starts to really run. And then I miss out on all the activity. In slow markets, the open and that first hour is really our chance to get an exaggerated move in the market. But these are extreme times. The entire day is going to give you an opportunity to trade in the market. So, don't feel obligated to jump into the chaos first thing in the morning. Maybe let it unfold a little bit. Like I've continued to say, and I'm going to probably just make it my motto, if you are losing more than you win, quit doing the hard stuff and start doing the easy stuff. There's different ways to trade. There's the hard way and the easy way. And of course, the hard way makes more money, but it is harder. Yeah. So if you're losing more than you win, quit doing the hard stuff. Start doing the easy stuff. This is a failed flag setup. We're looking at the daily chart on the ES. With the failed flag play, generally speaking, I like to use the fibs and let that develop my channel. So something like the 786-100 or the 7100 in this case, we want to see a breakout of these levels. I'd like to see something like a Busby there, but if it's a momentum breakout, there won't be a Busby, right? It's just going to keep on running because in momentum breakouts, we have to buy high, sell higher. Notice the lack of volume, right? And that's one of the key pieces that match the whole idea of, are we going to call a bottom? We need a serious, massive gap down and then a rally back up on elevated volume. We had that last Monday, but then we got nothing. We had nothing for the rest of the week, and we got a breakout day yesterday. Now it's a breakout of the level, right? So this is a good one. It's a critical level breakout. No volume. So when we have a breakout with no volume, then there's no backing of the institutions, right? This thing doesn't have uh, confirmation to it. There are plenty of places throughout history where you can identify that there was breakouts that had really great follow through that did not start with good volume. So I'm not saying that a lack of volume means that this is going to fail. It does mean we need to approach it with a little bit of caution. All right. That there is a lack of breakout volume. Now, I've had people ask, well, what kind of volume should I be looking for? Is there a certain level of volume percentage wise? I'll give it to you the way that IBD, which is Investors Business Daily, likes to point it out. You should be able to see, oh, damn volume, right? It shouldn't be like, yeah, we're slightly elevated, got a little bit of volume. It should be that you look at the volume and say, oh, damn, there's some volume. It needs to be that kind of volume if you're looking at breakout volume, right? So that's the kind of level of volume that you want to see. And throughout history, if you go back and you look at like really good breakouts that, chart the path and are used for examples, it was, oh, damn volume. And even now, where I'm zoomed out and you're kind of seeing this from a greater perspective, look at the volume from the other day where we were calling that bottom last Monday. It's significant. It really stands out compared to the other volume. Now, we're looking at the ES, but near the end of the day, I went in and was charting through all of the FANG names and then the indexes and then the sectors. No volume. There was an elevated MOC yesterday. We had 300 and something companies hitting MOC into the close on the buy side and like 190 on the sell side. So maybe that's where the volume was, but it still would have showed at the end of the day, and it's not there. So approach with caution, right? All right. So we are out of that range as discussed. If we look at it, volume by profile, volume by time, volume by price. Time is in blue, price is in green. We're entering into that shallow area. We can move through this very quickly, right? And so the next area is going to be pretty close to that 4,600. Use something like the 45.5 to start to realize you're getting into that resistance. And by 4,600, we should be just getting through the other side of it. We expect to move through shallow areas relatively quickly, right? Like, see how we came through it to the downside. We came through it very quickly. Because we came through it very quickly, we left a shallow imprint. The time profile doesn't provide volume support, volume resistance. We don't even approach it from that metric. So while there are some elevated levels around the 45, 43 area, the 45, 45, we're not expecting any of that to be an issue. We did tag first touch back here on this pivot. It's been resolved to a degree. We're still going to want to see an actual close through the other side of it, right? We need to know certainty that it has been resolved, that there is absolutely no liquidity left at that zone. We can't say that yet, but for a first touch play, that would have been a phenomenal thing. I was probably sleeping at 3 o'clock in the morning, so I say probably. All right, so shallow area. You can see we moved through a lot of this trash relatively well yesterday afternoon, but on what volume, right? That's what it keeps coming back to. So now that we're out of the box, what are we looking for? Well, a Busby would bring us back down, right? And it's a positive pattern. We expect it to come back down because when markets break out of a range, a lot of times they circle back and validate the old resistance as a new support level. This happens very frequently. So that's what we would expect. But if this is a momentum breakout, we wouldn't want to see that, right? We don't want to see momentum lag and shift and begin to fail and actually pull back like that. We won't know for sure unless it continues, right? We never know for sure. But if it was momentum, I would have expected more of a wedge before the break, and I would have expected more volume. So I'm thinking more of the beginning of a trend where we buy low, sell high, and that would imply we're going to see that pullback, that Busby. Remember, it doesn't owe you anything more than the back to the top of the range. So if we do get that Busby, we'll be aiming from one cog line to the other one, 44.11-ish, back up to 45.11. Anything beyond that, just set your runners. Since we moved through this area very quickly yesterday, if we break Globex low, we're very likely going to go back down to the open where we started the day yesterday. So that would be my target to the downside, back down to 44.11. It's the cog line is just easier to keep track of than the open. That would be my downside target if we break this Globex low. Now, when I say break, I do mean break and close below, right? It can wick down and come right back up. We're talking candle close, something on your higher time frames, 15-minute. We break and close below our current Globex low. I would be aiming for a retest of these values of yesterday. You could see a first touch play maybe on Globex high of yesterday, but other than that, I would expect to move back down through that relatively easy. If the markets do like the positive news that comes out today, or if we do get positive news today, then we're going to be focused on the ADR. The ES right now has an average daily range of over 2%, and we're basically flat right now. So you could just use your drawing tool and measure a 2% move from our current location, and you wouldn't be too far off. That would be a normal day, right? That would be what we just like, yeah, just another day in the market, about a 2% move. That would put us very close to 4,600 on the day. And I do believe that if we got that close, we would just go ahead and go to the six, right? So a 2% move to the upside will get us to 46. We'll be looking for a break of the Globex high to make that push in that direction. There is a cog line at 45.11. For the NASDAQ, that real lack of participation yesterday stands out. This is the failed flag play, same setup as what we had on the ES. If we run just a regular trend line connecting the first pivot after this break, then you can see that we're up against the angled resistance. So we would expect that to be resolved in some way today. It's the same situation as with the other market. We're going to be real data dependent. We're most of the way through that shallow area here on the NASDAQ, which means we're going to be expecting to run into that resistance around 15.2. So you're definitely going to want to keep your eye on that. There is an expectation with this 3% ADR right now that we could get another real big monster move today. It's hard to see that, right? With the lack of participation that we saw yesterday, it's just really hard to see that kind of follow through today. But we know that it can happen because markets can do whatever they want, right? We just try to approach it from a what's more likely scenario. Well, what's more likely is that we're going to pause here, right? That's the more likely outcome. Same thing, if we happen to break this Globex low, then it is likely we're going to uh, move through this area relatively quickly, just like we did on the way up. We would come back through it the same way. There's no volume nodes there to contend with. So we'd be focused on the open of yesterday for our target to the downside. If the news is positive or if the market does appreciate the news this morning, we'll focus on a break. First, getting through our own Globex high. We've got an ADR of 3%. So even if you was just to cut that in half, right? Just use your drawing tool from our current location, plot a 1.5% move. That would put us at 15.0. So an upside target of 15.2 is not out of line. That just seems like really big moves, right? I mean, like really big moves. They were talking about the 2 and the 10 kind of fading off a little bit. Keep your eye on those bonds. Notice the 30-year was kind of shaken up again this morning. Big moves. I know these may not seem like very big moves, but these are big moves. And in these moves, we can see the response from the market, right? So shock and awe from the bonds creates shock and awe inside of the stocks. Dollars continuing to fade off. When I start to zoom out and get a little bigger perspective, we've still got a VIX above, say, 20, which is still pretty significant. A continued fade in the dollar. The bonds, the 30-year at least, making some big moves to the upside. You see that 2-year, significant pop this morning. I mean, that thing just, maybe we're going to see a Busby on this, but that looks more like a momentum wedge. It's that 10-year that we monitor when it comes to calling bottoms and looking for that rally out. We want to see a consistent, persistent fade in the VIX, and we want to see that 10-year backing off. So we want to keep our eye on the bonds. Generally speaking, though, I just watch the ZB, right? I mean, there's nothing wrong with like taking a look around in the other markets, just see what's shaking, or using your watch list. That makes things really easy. But for the most part, the 30-year does it for me. All right, so the rest of these markets are doing well. We're not bifurcated like we were yesterday, and we're going to be looking for some follow through on these, especially the Dow. Keep your eye on that. That's your mega cap companies, and it's a different index when it comes to like cap weight versus price weight indexes. The Dow's a different beast, right? It's not like the Nasdaq and the S&P and the Russell. All right, so we're looking at trading view. We've got the S&P 500. We really don't want the S&P 500, right? So we're going to try to adjust this down to try to find just the top names on the list. Let's go the other direction. Want to get that down to around 100. $87, I guess. Never can quite get that thing to 100. That's close enough. All right, so from there, we've filtered it. Give it a little bit of a bump so it breaks it down into the sectors better. We need to change the color scheme. Right now, it's set at 3% on each end. We just want to set it to a decimal point, 0.3, so that it changes color quicker, right? You can see how PG, for an example, is still gray, or Berkshire Hathaway is still gray, but the rest of them are actually color schemed a little bit better. Now, the S&P has financial names where the NASDAQ 100 does not have financial names, right? So when we're comparing these two indexes, that's the one thing that we always want to put our attention to the most. When there's we're trying to distinguish the difference between the S&P 100 and the NASDAQ 100 in the morning, because a lot of these names are in both, but one has finance and one does not. So things that are kind of standing out and looking really good. Amazon this morning. Oh, one more thing. We're on price daily. We don't want that. We want pre-market change percent. Right? So we want to make sure we're actually looking at today's pre-market, not yesterday's close. So there's that negative sentiment this morning. Manufacturing, consumer services, non-durables, finance just fell out of bed, and retail. Right? So it's looking pretty nasty on the S&P side. Bring this over to the Nasdaq. Pre-market change percent. We don't need a filter, but we could set it out into the grids. Just change it to tenths instead of whole dollar numbers, and we see that red again. Communications, utilities, distribution. It's important to recognize that utilities are down. Real estate and utilities are considered safe havens in a bear market. They're also the difference when we're trying to distinguish like value companies, growth companies, things that are going to get hurt by inflation, businesses that can pass on, cost to their consumers. When tech was getting beaten down, normally we would have expected to see a lot of retail, utilities, consumer products, commodities. And the fact that we had that tech rally yesterday, while also seeing utilities down, at least gives a little bit of assurance that we are starting to see that capital rotation. They're rotating out of the utilities, out of real estate and places like that to circle over into technology. So this is kind of a confirming signal. Looking at the screener, this is an easy way to be able to quantify in a number value how we doing this morning. If we look at how many names in the NASDAQ 100 are up at least a half of a percent. This is down half of a percent. 10 out of 100 names are down. 16 out of 100 are up at least a half of a percent. That's a real wishy-washy kind of ambiguity morning. Not a whole lot of conviction in this. So that's the NASDAQ. We flip it over and look at the S&P. Up a half of a percent, and this is the S&P 100. They'll let me look at S&P 100 here, but not S&P 100 here. I got complaints with TradingView. It's okay. Yeah, it's okay. 12 out of 100. So we can also look at the downside of that and say, well, how many are down a half of a percent? 11 out of 100. Again, just that real wishy-washy, not a whole lot of conviction kind of morning. If you look at what sectors are up, silver, gold, the Qs are trying to come around a little bit. Technology, even cloud fits into that technology. Bitcoin is up slightly. So, we got a couple of sectors that are starting to come around, but if they're not up at least a half of a percent, then I really don't count it, right? It needs to show me some conviction. Cloud is one of those ETFs that we use to monitor different tech, and IGV is another one. So we want to kind of see IGV coming up on that list as well. If we look at what's down this morning, natural gas, energy, USO, XOP, finance is down a lot, utilities. Notice it's everything that isn't tech, right? Industrials are flat. We had a real beautiful setup in healthcare, but not seeing much of a follow through yet. Even small caps are kind of getting whacked. Right. So then there was a lot of talk about chips this morning. Want to at least take a glance at them. NVIDIA. Name moving around a little bit this morning. It's up 2.8 already. AMD's right behind it, riding that tailwind, and then NXPI. So, there are quite a few names this morning in the chip sector that are making moves. It's worth keeping your eye on. Let's see. Take a look at airlines. Yeah, kind of flat. Not even worth. Crypto's up this morning, so it's worth taking a look at crypto. Notice some of the names in crypto are some of those chip names, right? Got AMD, NVIDIA. This crypto list comes from the crypto futures offered at the Smalls Exchange. So if you were to go to the Smalls Exchange and download their weights and components PDF, you would see the list of names inside of it. That's where this crypto list came from. Want to keep your eye on the EV market for a continuation of that push from yesterday. XOS, RIDE, LCID, right? XPEV, even Ford and GM are getting a little bit of love this morning. So those legacy markets. Tesla continuing to drift after yesterday's push. So a lot of names in the EV market this morning looking really good. Yeah, I mean pot's not too bad. Kind of a mixed bag. I know that's an old joke. All right, so that is the morning. Be careful, guys. Watch the clock. Keep your eye on those bonds, and watch. Yeah, just be careful, guys. Just it's going to be a day, right? But by 11, you'll be done with your announcements and be ready to go for the afternoon.